So, as is usual now, we're going to cover very specific topics: the treasuries, the economy, the Fed, alts, and then our takeaways. So, yes, we have moved. One of the takeaways at the end is going to be meeting with each of you either in person or through Zoom just to reevaluate how we're invested and how our new platforms and everything will assist you in seeing your accounts, but also assist me in allocating your funds in a way that might make sense. So 20-year treasuries, they are down year to date. They're about where they bottomed out in February, maybe even a little bit lower. This is a good opportunity to start accumulating again in that area. And the reason why they're down is the Fed keeps dragging their feet on whether they're going to cut interest rates, and they're going to be forced to at some point. So long-term tips, same situation. They're because we had inflation tick up again. They're doing a little bit better than the long-term treasuries. But remember, when you're buying them at this price, you're getting a really good yield on them. So you get the yield in the interim, and then you get the growth as the interest rates start to come down. Okay, where are rates going? So this is a Babylon Bee article. So for those of you that don't know who Babylon Bee is, they're satire, but unfortunately, it's all too appropriate for what's going on. So California proposes another minimum wage increase so people can afford products made more expensive by the previous minimum wage increase. For those of you in California, we are the test ground for bad ideas. So, kind of to add to this, Gavin Newsom minimum wage for fast food restaurants was raised to $20 an hour, which forced a lot of fast food restaurants to cut their staff and really turn towards AI, self ordering, and things like that. So we'll see a lot of that in the near future. But what this means for rates, as rules like this, things like this, laws come into effect, it creates inflation. Inflation is what the Fed says they're battling. And the way they battle inflation is by raising interest rates. However, the more they raise interest rates, the tighter the economy gets, and the more likely we have a hard landing in the stock market and in the economy in general. It causes companies to start laying off people. And so ultimately, what's going to happen is the Fed is going to have to stop battling inflation and try to save the economy and try to soften the landing. The Fed should have stopped cutting interest rates and started raising interest rates sooner, and they should have started cutting rates last year at some point. So if you look at the inflation rate and seeing it start to tick up, they should have started cutting interest rates when they saw the rates were getting down near where they wanted them to be. Now they have the pressure of inflation going up, which goes against what they said they wanted. And so it's going to make them pause on raising or cutting those interest rates in the interim. And it's going to make the situation worse rather than better. I know that was a lot of just verbal explanation, but know that the rates are going to come down and probably 85% likely they come down at least 1% in 2024, and maybe more than that based on how fast the market turns around and comes down. So we talked about the market a minute ago, how I think it's going to correct 8 to 10% and then bounce back up. You may remember, for those of you that were around 5 or 6 years ago, we talked about a melt up. And that's what we're in the process of right now, and likely to see that melt up continue until we have an overall correction of 50% potentially. Okay. You'll notice a very unique situation here. We've got the US GDP minus US federal debt, which is the red line. So until 2009, that number was rising. 2008, 2009 happened, and then the debt just started going through the roof. So you'll see our debt has far exceeded our GDP now. And normally when that happens, you start to see the overall stock market go down. But what have we seen? The stock market's gone up for the last year. So the bigger that gap gets, the farther down that red line gets, and the higher up the green bars get, the more likely, the bigger the drop we're likely to see in the stock market. And the Fed can't do anything about that at this point. So it's going to happen. It's just a matter of when. And it's a matter of how they soften the landing. So stimulus is one way. So there's different types of stimulus. There's cutting interest rates, which frees up money. There's sending money to citizens, tax rebates, things like that, that will stimulate the economy. But if you're doing that, you're creating more debt. So it only makes the situation worse and worse and worse. So at some point, it's a rip off the Band-Aid and let things fix themselves. So the Fed is kind of just playing a game that they can't win at this point. And what that has done is caused gold to hit all-time highs. So over the last month, up almost 8%. Same with silver. Silver's up about 15%. So there's been a big move towards safety. There's probably going to be a dip. There's going to be some profit taking, and then I think ultimately I see silver going to 40. So there's a lot of ways to take advantage of that. That position has done really well for us over the last few years. Okay. Bitcoin. So you'll see Bitcoin over the last 3 months. We had a sharp increase, and then over the last month or so, it's kind of been bouncing around. I will say that over $200 billion has been added to Bitcoin ETFs just in the last month. So there's a couple interesting things going on there. One is you've got a ton of money going into it. At the same time, you've got what's called a halving. And what that means is the miners who follow the Bitcoin ledger and keep track of it and earn interest or earn Bitcoin for doing that, the amount that they earn is getting cut in half. So it makes it less attractive to be a miner on Bitcoin anymore. It also means that the supply that's available out there, or the amount of increasing supply, goes down. So there's there's a limited amount of Bitcoin, 21 million. Not all of that has been mined yet, but once it gets to 21 million, there's no more. So that's why it has a value that moves with inflation, uh, because it is a limited asset in the same way that gold and silver are. So there's certainly some reasons to be involved in Bitcoin and other cryptos. I do think we could actually see it come back down to that 40, 43 level. It's not very likely, but if it does come down to 43,000, buy it. Because I think it's much more likely that we see it at 100,000 this year than at under 40. Bitcoin's a good place to be, a good hedge, especially with the stock market likely to come down in this calendar year. Solana's, I think it's probably going to 500 this year. With both of these, you really need to talk to me individually, and we can figure out if it makes sense for you to invest in these and how to do that and to what extent. But you don't want to have more than 2 to 5% of your net worth in this type of investment, because it could go to zero. So you'll see this Solana got up over 200. It's down to one set. I think it even got below 170 today. So in my opinion, that's a good buying opportunity, good place to get in. When I started talking about this, it was down in the $75 range. So I still think there's a lot of potential there. NVIDIA. So this, I think what we're seeing here is what I talked about in the overall market. I expect that 8 to 10% drop in market value. I think it's hitting the AI stocks initially because they've gone up so fast. Now they're taking a pullback. I think we could see NVIDIA get up to that $1,100 a share, but then I think it's likely that we see it at 350. I think that's a reasonable value if you look at it compared to other stocks and how they perform when there's euphoria. So is it worth jumping in and potentially riding it up to 1100? Maybe. If you're in a portfolio that's being rebalanced regularly and that's not the only position, and again, you have less than 5% of your net worth in that one position, then it could definitely be worth it. That being said, there's going to be opportunities to get in much lower than where it is now. So there's our team, but then there's another 45 to 50 advisors that also left with us. So MassMutual was not happy about that. They held on to our email and our phones for a while, so that made it difficult. You may have reached out to us via email, and those emails just went to no man's land. So I know I've talked to a few clients that were like, hey, you never responded. Well, everything is up and going now. We have our same emails, we have our same phone numbers, so everybody can reach us there. We are just getting to the point where the majority of our managed accounts have moved over, and we're starting to move annuities and things like that. I will say any MassMutual products, annuities or insurance, they are not currently giving us a broker contract. And what that means is you will continue to have that product and somebody else will be assigned to it. We can certainly advise you around what to do and keep you on the same path with that. We just won't be the advisor of record. So we won't be able to access it online or do any of that. That being said, we do expect that to be changed within the next 2 to 3 months. So it does not behoove MassMutual at all to not have us have broker contracts. So that should happen at some point, but our lawyers are talking to their lawyers, and until all of that's settled, it probably won't happen. But for the most part, we're up and running at 100%. I know there were some questions about having access to accounts. Some of you should have access to AdviceWorks at this point. AdviceWorks is our Investor 360 replacement here at Cetera. So we're releasing it slowly to clients because we want to work out any bugs and kinks and things in advance. So you guys don't have to work through those. So far, so good. But you should be seeing that stuff get sent out to you soon. Tracy, anything you want to add?
I just want to apologize again to anyone who got 20 emails when we first made the move. And there will be future outreach, but not that crazy, about things like what Matt was just discussing, helpful videos on how to get into your AdviceWorks, educational stuff around helping you do all the things. That stuff is coming. Our new website is in the process of being built. So we're looking to roll out a bunch of resources to help you on the fly and whenever you need in the coming months.
So the market seems to be slowing, but we'll likely have one more spike up. Long treasuries and tips are at a buy price. Inflation continues to tick up. Fed will likely be forced to cut. Silver and gold continue to rise off the February lows. Along with the market, most cryptos have slowed despite 200 billion entering the Bitcoin funds this month. Nvidia in the 800s and could still hit 1100. So what do we do with that information? Continue to peel off gains from the stocks, buy longer term treasuries and tips, continue to move into silver and gold, expect a potential pullback after large move up, consider moving into crypto, AI, and energy income with recent pullbacks. Can't see my whole screen. Meet with me individually, in person or in Zoom, to discuss the right allocations. So now that all these accounts have moved over, it's time to start really getting in there and looking at each account, starting to look at how can we shift money out of the S&P 500, still have it tied to stocks, and that's where having 1 to 5% in crypto or 1 to 5% in AI or another 5% in the energy dividend area makes sense. So yeah, certainly reach out and we'll get those scheduled.